Before you start the event, I will request to all the students, please mute their microphone.
Let's wait for a couple of minutes. I am trying to catch hold of President Sir. He was very enthusiastic. He wanted to join the inaugural session, definitely. Let me talk to him if you can join in a few minutes. Good morning, all of you. A very good morning to all. Uh, it's a great pleasure to speak in an event like this and webinar for 3 days talking about stock trading for the layman. The webinar topic is very close to my heart. I mean, I definitely am a layman when it comes to stock market trading, and it has always been intriguing me. And definitely, like we have all known that this is one area where substantial money can be made and substantial money can be lost also if we are not doing things right. So definitely this is going to be an eye-opener, a very good learning experience for all the participants here to hear the tools and techniques of the trade from the experts here. I am very happy that uh, we have now a registration number of over 225. Over 225 people have registered for this program. And already I am seeing that 140 participants have already joined in. Our president, sir, Dr. Satyajit Chakraborty, has also logged in already. So are the CMT organization's India head, Mr. Joel Panikkar. I'd not take much of your time, and I'd just get into the topic immediately. I'd hand it over to Mr. Shogato Ghosh to introduce Mr. Joel Panikkar and start this program. After his introduction, our resident sir will inaugurate our session today.
Thank you, Principal Sir. Am I audible, sir?
Yes, you are audible, loud and clear.
Okay. Respected seniors, my colleague and student, hope you and your family are safe and fine during the COVID period. I am Professor Shogata Ghosh, co-hosting of today's event. Would you like to give a brief introduction of Mr. Joel Panikot from CMT Association? Mr. Joel Panikot is the head of India, the liaison office of the CMT Association. Through industry, the partnership, educational programming, and brand the post training. The Joel is working in advance, the describe, the technical analysis, and he worked with the volunteers in India to support the growing community of CMT Association members and candidates to deliver their rewarding the engagement experience. In collaboration with CMT Association, the volunteers present innovate farms, universities, exchanges, and prospective the candidate about the value of CMT designations. Joel has the close of 2 decades or experience across the various industries prior to join the CMT Association. He worked as a derivatives trader and ran the Bloomberg educational business strategy across the Asia Pacific region. He has also been a CEO of 2 educational technology social enterprise. He is also deeply invested to motivation through the listening of mechanics of appearing in his role and the educational business leader. Now, I would like to give the charge to our principal sir for inviting Mr. Joel. Thank you, sir.
Uh, I cordially invite Mr. Joel Panikat to uh, speak to this occasion.
Thank you so much, Professor Anupam, Professor Shagato, and Professor Satyajit. So nice to be seeing all of you in person. That itself is a rarity these days. So I hope that all of you and your families and the families of everyone attending this workshop are keeping safe. I mean, we are in a crazy time in the history of humanity. And at this time, I think staying safe, staying secure is probably our first priority and keeping each other safe as well. So I hope that all of you are taking care. Um, and this is actually a very fascinating time to be conducting a workshop like this as well. So I really would like to applaud Professor Shogato on the initiative he's taken to kind of put the session together. He has spearheaded, in fact, the partnership that IEM Kolkata has with the CMT Association as well. And I want to, so what I'll do today is, tomorrow I will be joining you for some time to talk about technical analysis, the careers in technical analysis, etc. But today I just want to touch, for a change, I want to not use a slide deck because you'll see enough slide decks between today and tomorrow. And I want to just talk a little about the CMT Association and the academic partnership that we have with IEM Kolkata and institutions around the world. So, just by way of background, the CMT Association is the world's foremost credentialing body in the space of the specific study of technical analysis. Now, as you are part of this workshop, you know that technical analysis and fundamental analysis are two very distinct and unique ways of analyzing financial market securities from the purposes with the vision to invest and to manage risk, right? So you will learn a lot more about what technical analysis is, how that came to be, and so on and so forth in the next few days. But with the CMT Association was born out of Wall Street in the late 60s. And this happened when a group of technical analysts wanted to get together and discuss what is the latest in their discipline of study so that they could help each other learn and grow. So this happened around 1969 when the first few founders of what is now known as the CMT Association got together to have meetings, and as an offshoot of what was then called the New York Society of Securities Analysts. It's very funny. You will all have heard also of the CFA Institute, and both the CFA Institute and we share this common DNA of having been born out of the New York Society of Securities Analysts. So the CMT Association began, like I mentioned, as a group of technical analysts getting together and discussing what is the latest in their profession and what is the cutting edge of the discipline at that point in time. And as that grew, the influence and the reach of the association kind of grew across the United States, and then eventually went and spread around the world. And so, as a result, the club, as it were, grew bigger and bigger and bigger. And eventually, it was decided that there should be a certain level of excellence that the members of this club should meet in order to even get into the club. And that was how the CMT program, which exists in its current form, was born. So this happened about 10 or 15 years after the establishment of the association. It started, like I said, in 1969. It was formally incorporated in 1973 as then the Market Technicians Association. In the early 80s was when the CMT program was created. And a few years after that was when this idea of the academic partner program was born. So the CMT Association very strongly believes, and it is in fact known, that the future of any discipline comes from academia, from the way it is taught and learned within educational institutions. And so the CMT Association started a journal, an academic journal for research publications called the Journal of Technical Analysis. It is a standardized, double-blind, peer-reviewed academic journal where the cutting edge of technical analysis research is published, so that the discipline can be taken forward more and more actively. Apart from that, what we also work with academia to do is to encourage the teaching and learning of technical analysis, because this is a discipline that is finding greater and greater application in the financial services industry. And what we are doing is, as an association, as the world's, like I said, foremost advocacy body for technical analysis, we work with regulators like the Securities and Exchange Commission in the US, like the Securities and Exchange Board of India in India, of course, the Monetary Authority of Singapore. So we work to help them understand the application of technical analysis that helps to further the objectives of the regulator, which is primarily investor capital protection and investor education. But in order to do that, we also work very closely with industry participants, with employers across the entire financial services industry landscape. So whether it's traditional industries like broking houses, like investment management houses, banks, corporations, especially the treasury function, and more modern industries like the space of quantitative finance, algorithmic trading, the application of machine learning and artificial intelligence in these spaces. So what we generally know as the front office of financial technology, or fintech as we call it. So there's a lot of work going on in these spaces as well. And we are building more and more awareness around the importance of understanding technical analysis for front office professionals. So in order to do that, and what we're doing in this space kind of creates a demand for people with an understanding of the discipline of technical analysis. And so we also try to address the supply side of it. And the supply side is helping more and more students get career ready and job ready by learning technical analysis at the highest level, so that they are able to fulfill the demands of the industry. So these are the areas within which the CMT Association works. And as a result of that, the academic partner program was created in order to encourage this environment of learning, teaching, and research. So I'm very proud that IEM Kolkata is also part of this community, and I would obviously encourage all of you as students, faculty members, to learn more and more about technical analysis, because not only is it a career skill for all of you who are interested in careers within finance, but I would argue it's a life skill as well. Like Professor Anupam mentioned, even as a layman, we have earnings and therefore we have savings. And if we want our savings to keep up with or do better than inflation, we need to invest those savings. And when we invest those savings, we seek returns, but far more importantly, we seek to avoid risk. So technical analysis becomes very important there. I mean, I would argue that both fundamental and technical analysis have their own unique role within the space of financial markets analysis, stock analysis specifically, because as a layman, the stock market is far more accessible to us than, let's say, the bond markets, the currency markets, and so on. So understanding what these methods of analysis are, understanding how can we use them to find the best investment opportunities, and therefore to protect ourselves from the risks that these investment opportunities bring to us, is really critical. And for students, as young people starting out in your careers, I promise you, if I would have had someone telling me about fundamental and technical analysis when I was your age, I probably would have been a lot richer today. So I wish you happiness and health and wealth. And I hope that this workshop over the next 3 days helps you to enhance that wealth. I'll not take up more time now, and I'll invite Professor Anupam to take over the session as well. I will see you all tomorrow, where we'll talk a little more about the career possibilities within technical analysis, what kind of jobs exist, what kind of preparation you can do. And two senior CMT charter holders will also talk to you about how technical analysis as a discipline can be learned, what are the early rudiments of it, and how can you apply it in a real world case scenario, which we will then discuss on Sunday. So on Sunday, you will look at both technical analysis and fundamental analysis applied to this, a very similar investment scenario. And from there on, hopefully that the learnings that you have in these 3 days will coalesce into something that you can actually put into action going forward in your careers and in your lives. So all the best to you. Professor Anupam, thank you so much.
Thank you. Thank you, Mr. Joel. Now I'd invite our President, Sir, Dr. Satyajit Chakraborty, to address us. Sir, you'd be glad to know that across the students and faculty, we have had fantastic reception of this event. 227 participants have registered for their interest for this particular event, of which we have students and faculties of IEM, we have students and faculties from UEM Kolkata, University of Engineering and Management Kolkata, and University of Engineering and Management Jaipur as well. And just to share a little bit of statistics, because for the next 3 days, we'll be seeing lots of numbers and try to analyze numbers only. We have quite balanced participation from both the genders. About 50-50, we are seeing male and female participants in this particular program. And then if I go into, say, like the percentage of students and faculties, it's like 90 to 10% of faculty and staff members and 90% of students. So it gives me lots of pleasure to see lots of young people are warming up to the idea of investing and trading. And as Mr. Joel had rightly told you, it is not always about just that return. It is also about trying to manage the risk. That is the most important lesson, most important takeaway I want to take from these sessions. As per the IEM, UEM, and other institutions that have participated, we have about 73% coming from IEM and about 25% coming from UEM, 2% from other institutes. And in terms of the educational background, although we have done it primarily for our MBA students, but I am glad to see that about around 11% of students from other disciplines, including BTech, the basic science and humanities, and all the other being taught at IEM and UEM, students have shown interest. So, Sir, President Sir, if I may like to invite you to please inaugurate the session.
Thank you. It is already inaugurated. Joel Panikar has done it such a nice way of introduction that really I will be saying things, only repeating what he said. I will request all the participants that kindly remember that time and tide wait for none. So these 3 days of this workshop, please take full advantage of that. Please take full advantage of that, because You may do a very good job or very good business and all that, but you do not know when things will be going bad. Like who ever imagined about pandemic? We never imagined. We were constructing our building, we were planning so many things and all that. Now for last 1 year, not a single student has come to the class. No teachers are coming to the class. I am really at a loss to understand where we are standing. We are just sliding down and down and down, and that is happening with almost everybody. Now, this situation may happen again in some form or other. But those who are good in using the stock market, for them, even during loss, they will make profit. Even during gain of the stocks, they will make profit. Now, this requires full understanding of the economics, full understanding of the politics, full understanding of the whole world environment. Besides, one must understand the economics and the mathematics behind that. There are some companies who are making profit, but you find their stocks are stable or making a loss. Whereas there are some companies who are not making that much of profit, but their stock price is going up. Today, there are a lot of software which prevents you from making big loss. For example, you decide that I'll not make a loss more than 10,000 rupees. Okay. So you make a stop loss arrangement with the software, and before the price goes down, all the shares will be automatically be sold. These sort of things are there. I am sure this will be discussed in detail during the workshop. My request is that please try to understand the mechanics and mathematics and the logic behind it. If you do it, you may gain. Otherwise, without understanding or without knowledge, you may make some profit also. But that will be gambling. There is a difference between a well-made decision and a gambling. The stock market operation is an intelligent, knowledgeable decision, and that can be done by anybody. It really does not require a great mathematician, but you should have some mathematical background and the appreciation of mathematics, which I'm sure those who are studying in this institute or those who are teaching in this institute or working in this institute has all that very well. So please take this as an additional career, You may be doing a job, but at the same time, you may do part-time in the afternoon or maybe during the lunch time, do some stock market operation. If you are good in understanding, you will make money. Believe me, you will make money. And the chance of making a huge loss is not there, because today's software is there. You can make a stop loss arrangement with the software and automatically it will take care of that. So, but these are all good for those who knows it well. Those who do not understand or do not know detail of it, they will make loss, huge loss. So please try to understand that by operating this stock exchange, you are helping the country, you are helping the economy, you are helping creating jobs. So don't think that you are doing some gambling or other things. No, you are not doing. You are doing things so that economy is looking up, so that employments are created, so that countries progresses. Any country who has progressed, like say USA, UK, even China, their stock market is a booming stock market. Very good stock market is there. And USA and Canada, when I was there, I have seen all my colleagues, without any exception, they used to operate stock market options always. And all of them, all my friends were doing service. But they all part-time during lunchtime, or I don't know how, in what time they will find out, but they will always do some stock market. I have not, till now, I have not met any person, educated person, who says that I don't care for stock market, or I don't have any stock market operation. So I fervently request all of you to take this workshop very seriously, learn it and practice it. And we have Professor Anupam Bhattacharya, Professor P.K. Banerjee, who are expert in this field. And our director of IEM, Alex, is also an expert in this field. But this workshop will be taken by far superior experts. And I'll request to all of you to take full advantage of that. Full advantage of that. It will really be a great boon to your career and wealth generation. Thank you very much. Thank you. Thank you very much.
Thank you, sir. Thank you for this inspiring talk. Definitely what you have told, this will have lasting impression in the minds of all the students who are taking part. Definitely they have shown interest because they also from the bottom of their heart believes in the forward looking like projection that the stock market, the script market gives, and definitely they have signed up for the program to learn both the investment decisions, what to invest in, and the technical analysis, when to get into the positions, and when to cut your losses, when to exit from the positions. This is also extremely important. So as Mr. Joel has already said, over the period of 3 days, there are two of the most important areas, distinct areas you will be learning. Today's session will be around fundamental analysis taken by our beloved and very much respected Professor P.K. Banerjee. In fundamental analysis, you will understand and identify what all are the indications of a good, respectable company, what all are the indications of where you'd put in your investment decisions. Tomorrow, from the experts of CMT, we'll be learning about technical analysis. We'll be learning to understand many of the charts, understand the movements of price, and try to identify how and what are the good opportunities, when are those good opportunities coming to enter and to exit. Okay, and then on Sunday you will have case study, real life case study analysis of both fundamental and technicals. So I'd invite Sir P.K. Banerjee sir, and I would like to thank all of you who have already shown interest and joined in. We are in for a very interesting ride of these 3 days. And thank you, President Sir, for your encouraging speech once again. I know this subject is also very close to your heart. Whenever I have uh, discussed with you, you always encouraged us to learn more about the markets and uh, use that as one of the, as you have already told, we may be doing certain other things as our primary occupation, but uh, on the back of our mind, keep some space for like risks, returns, understanding of markets, and participate in the market dynamics. PK Banerjee, sir, I'd like to invite you and take charge of the session now.
Thank you, Professor Anupam. It is a pleasure to be involved in a program like this. Uh, uh, for long, I had been hearing from our respected President, sir, that such an initiative should be started at the earliest. But I must say that the association with CMT did give a fillip to the efforts which were being made behind the scene to have such a program. So I am extremely proud to be associated with CMT in conducting this program on uh, stock trading for the layman. Uh, Let me start off by sharing with you some basic matters before I get into the details. Is my screen visible to all of you?
No, sir.
No, sir, we don't see the screen yet. So there is this small green share screen button at the bottom of the uh, frame.
Sir, first of all, you open your PPT in your desktop or laptop and then share the screen. After that, your PPT has select and share.
Is this visible?
No, sir.
No, No,
Is
sir,
it visible?
not yet. Not
Not
yet.
yet. Not yet, please.
Sir, if you could, if you want, you could send the PPT to myself or Mr. Shogato, and we can run the PPT ourselves.
No, it is already sent to Sogoto.
Yes, sir.
Okay.
I will share. Just a minute.
Then let Mr. Shogato share, and you will
Yes, sir. Just
direct him.
sir, this one. Now we can. So this is the first one.
Yes, please. Thank you.
Most welcome, sir.
Uh, can you make it full screen?
Yes, sir.
Yeah. Is the screen visible now?
Yes, sir. The screen is completely visible.
Okay. Okay. So this is just to introduce myself. I'm Professor Pradipta Kumar Banerjee of the MBA department in the Institute of Engineering and Management. I teach in the area of finance mainly, and I do take subjects like security analysis and portfolio management. I take part of the derivatives course. I take corporate finance. So in my practice of teaching students, many a time I have found that there is a great interest among the non-finance specialization students to also know about some of the basics of stock trading. So that is how the idea originated in me, that with the type of encouragement given by President Sir and with the type of associations that we have now with CMT, why not enlarge this program for the body of students who are other than finance specialization students, so that they can get involved with managing their savings and managing their risks as a part of their ongoing career in course of time. So uh, can we have the next slide?
Yes,
Yeah,
sir.
yeah, you can. Yeah, next. Uh, yeah. Now one one of the basic things of stock trading, which everybody gets to deal with at some point or the other, is that okay, what type of stocks should I buy, and what is the right time to buy those stocks? Okay. So the basic issue of what to buy is something which is answered by the use of fundamental analysis, and when to buy is indicated to you by technical analysis. Now, the sessions which I'll take today will be basically on fundamental analysis. But just to appreciate what is the difference between fundamental analysis and technical analysis, let me go to the next slide. Can
Just
yeah. Now here you will notice that fundamental analysis, that is your decision of what to buy, is basically based on an analysis of various economic and financial environment which is prevailing in the country and across the world. So it involves a look at economic conditions. Takes a look at the industry conditions prevailing in the industry in which that company is located. Then it involves analysis of the company, its financials, and its business outlook in order to arrive at a decision of what is the right stock to invest in. And arising out of this analysis, you have to come to what is called the intrinsic value of the stock. We will talk about this intrinsic value in more detail as we go along. However, technical analysis is based on a different premise altogether. Okay, here you are relying more on moving averages of the price data upon the volumes of trading in a particular stock. You are looking at indicators and oscillators. You'll know more about these terms as we go along in the sessions on technical analysis. So your focus is what is the right time to buy the stock which you have selected as a part of your fundamental analysis. So fundamental analysis and technical analysis are two sides of the same coin. Okay. You cannot have a technical analysis without having an understanding of fundamental analysis. Because if you get into technical analysis without some understanding of fundamental analysis, it is possible that you may end up making a very big loss. So fundamental analysis and technical analysis both have to be understood in order for you to trade profitably in the stock market. However, as I have said earlier, I will focus on fundamental analysis. So we can go to the next slide. Yeah. Now, fundamental analysis is something in which you choose a stock based on your analysis of the economy, of the industry in which that company is operating, on the future prospects of that company, and then having made that investment, you are not in a hurry to exit from the stock, but you want that investment to grow. So one of the premises of fundamental analysis is that identify stocks which have a growth prospect. Okay, what we call value investing. So even if I invest in this stock at a particular price today, over a period of time, I will expect the value of this stock to gain significantly. So we are talking about value investing, which is very much a part of the fundamental analysis that we talked about. Okay, so we can have a look at the next slide. Here, I would like to speak about one of the very well-known quotations of a, a guru in investing, Warren Buffett. All of you have heard about Warren Buffett. He is among the 5 richest people in the world. Sometimes he is third position, sometimes in the fourth position, but he is within the 5 richest people in the world with a net worth, his own wealth of about 80 billion US dollars, 80 billion US dollars in the year 2020. Okay. And he has given from time to time various, quotes which have become quite popular. Okay. And one of these quotes, which I have just now put on the screen here, is no matter how great the talent and the efforts, some things just take time. You cannot produce a baby in 1 month by getting 9 women pregnant. Now, what is the intention of this quote? The intention is very clear that for your investment to grow, you have to give time. In order to make a profit, you have to give time. So having selected your stocks through fundamental analysis, you have to give some time for the stock to give you the returns. Okay. That is the whole idea, that time is a major factor which you have to keep in mind, because the fundamental analysis will indicate to you the stocks which will give you a profit in the medium and long term. Okay. Now let me give you an example. Can we? Okay, before we go, okay, we can go to the next slide, please. Yeah. Okay. We'll talk about these examples when we take up the basics of fundamental analysis. Now, it is very, very important that when, when you want to identify the stocks to be selected, you must have a good understanding of financials, of how to read a balance sheet of a company, how to understand the balance sheet and profit and loss of a company. Okay, how to decide whether the company is doing well or not doing well. What are the red flags you should look out for? Therefore, in any exercise in fundamental analysis, a good understanding of the balance sheet is very, very important. Okay, so we have structured our discussions in these sessions into three parts. First part, we will discuss about how to read a balance sheet from a very layman's point of view, so that anybody who has no basic idea of accounting or finance, he or she will understand what a balance sheet is all about and what kind of inputs can be drawn for fundamental analysis from the balance sheet. Having understood this basic thing, we will then move into the basics of fundamental analysis. And finally, in the session in the afternoon, we will talk about estimating the intrinsic value of a share. Okay, that is ultimately what you are looking for. How to estimate the intrinsic value of the share, and based on that, you will then get into the area of whether what is the right time to buy the share, is it right time to hold the share or to sell the share or not. So those decisions will follow after you have made an assessment of the intrinsic value of the share. Okay. So first, therefore, the first part of our sessions will now concentrate on how to read a balance sheet from a very layman's point of view. Okay. So anybody who does not have an understanding of even finance or accounting, he or she is able to understand what a balance sheet is all about and what type of inputs he or she can draw from the balance sheet. So let us go to the next set of PPTs. Okay, so I will request Professor Sogoto, can we go to the next set of PPTs, please? How, how to read a balance sheet. Professor Sogoto,
Yes, sir. Yes, sir.
uh, have you shared the screen?
Yes. Yes, sir. Is it visible, sir?
Yeah, yeah, you can enlarge it, please.
Already, sir, enlarged.
And can you give it full screen?
Yes, sir. It is full screen.
Okay. I think it is still, is it full screen now? Can we go to the next slide? Can we go to the next slide, please?
So already in the next slide, sir, how to read a balance sheet.
Yeah, now go to the next one.
Sir, you
Are you able to see?
Yes, sir, we can see, sir. It's written a balance sheet is a statement of what an enterprise owes.
Okay. Okay. And it is full screen. Is it full screen?
Yes, sir.
Okay. So let us see uh, what is a balance sheet. A balance sheet is a statement of what an enterprise or a company owns and what it owes as on a particular date. So I'll repeat this. A balance sheet is a statement of what an enterprise owns and what it owes as on a particular date. The things that an enterprise owns are called assets, and the various sums of money that it owes are called its liabilities. Quite simple. So what you own are your assets of that company, and the various sums of money that you owe are called its liabilities. The name balance sheet comes from the fact that the total assets always equal the total liabilities. So it is in balance. The total assets have to be equal to the total liabilities. However, one of the limitations of the balance sheet is that it can only show those assets and liabilities which can be expressed in monetary terms. Okay. Now, we will talk briefly about this limitation towards the end of this session on how to read a balance sheet. But you have to keep in mind this very, very important limitation that a balance sheet can show only those assets and liabilities which can be expressed in monetary terms. The liabilities indicate the money that has been made available to enterprise from different sources. So what are these liabilities? They indicate the money that has been made available to the enterprise from different sources. And the assets show how the enterprise has employed or used this money which has been made available to it. Fair enough? So liabilities indicate what are the sources from where this money has come from, and the assets show how that money has been used on different items. You can go to the next slide, please. Next. Can we go to the next slide, please?
Professor Shogato, I think you have skipped a couple of slides.
yes, sir. That is an sir. You just check it out.
Probably Professor PKP was unable to see. Sir, in the next slide, there was this description of assets and liabilities.
Yes, please.
This one, right?
Yes.
Okay. Please go to the next one, Shogato, sir. No.
Yes, these are the assets.
Yes, assets as in
Yes,
current
sir.
assets, fixed assets, and intangible assets. Is that the slide, sir?
Yeah, assets. It starts with assets. Yeah.
Yes.
Sir. Now it is on the skin, sir. Full skin.
It is not visible.
We are seeing it, sir. Mostly it's visible.
And now you can check it out.
No, still it is not visible on my screen.
Sir, I think there is a network issue on your side, sir.
Yes. Due to some network issues, that reason you cannot see the slides.
What you can do, sir, is on your side.
Yeah. Now it has appeared.
Okay, it has appeared. Then fine. Thanks.
Okay. Okay. So we have talked about asset liabilities and assets. Now let us look at assets. Assets can be divided into current assets, fixed assets, and intangible assets. Okay. Assets which are likely to be converted into cash during the operating cycle of the business. And what is this operating cycle of the business? The period between buying the raw materials and selling the finished products, that is the operating cycle. So the assets which can be converted into cash during this operating cycle of the business are classified as current assets, such as cash in hand, cash in the bank, cash and bank balances, sundry debtors, that means receivables. So once you have billed the customer and you have yet to receive the money from the customer, it appears as sundry debtors. And then you have all types of inventories like raw material inventory, the work in process inventory, and the finished goods inventory. All these are part of what is called current assets. Okay. So this is the operating cycle of the business. You have cash, you buy raw materials, you convert the raw materials into finished goods, you sell the finished goods. When you sell the finished goods, it becomes a sundry debtor, and it remains a debtor until you collect the cash from the customer. So during the operating cycle of the business, the involvement, the cash which is getting invested in these different items, those are called as current assets. Are we clear? Fixed assets are, however, quite different. They are acquired for the long-term use in the business. Okay. That means examples are like plant and machinery or buildings or furniture fixtures, vehicles, all those which you acquire with the purposes of using it in the business for the long term. Okay. Now, assets are grouped according to their liquidity. That is the ease with which they can be converted into cash. Some current assets are known as quick assets. Okay. So they are called as quick assets. Why? Can we see the full screen? Okay. Is the screen visible?
Yes,
Yes,
sir.
sir.
It is visible. Okay. 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 So quick assets are those which can be readily converted into cash. Now, for example, when you have got sundry debtors, money which the customer has to pay you, that money you can collect relatively easily, okay, by following up on the customer and collecting the money. However, if there are inventories which are lying with you, for example, finished goods which are yet to be sold, or there is inventory of raw materials, now those cannot be easily converted into cash. They will take some time to be converted into cash. Therefore, when we look at quick assets, we look at current assets without taking the inventories into account, because those the inventories are those items which cannot be easily converted into cash, unlike sundry debtors. So if you leave the inventories out of current assets as your numerator, you take it as a numerator. So the current assets minus inventories become your quick assets. Okay, you can go to the next slide, please. Okay. Valuation of assets can be either at cost or market value. Okay, so I can value those assets at the cost at which I have procured them, or the assets can be valued at their current market price. Okay, for example, if I have got finished goods lying with me, I can value those finished goods at the cost of producing those goods in my factory. What is the cost in producing those goods in my factory? I can value them at that cost. Alternatively, I can value those finished goods which are lying in my warehouse at the price at which they will sell in the market. So that is the market value. So assets are normally valued at cost or market value, whichever is lower. Okay, whichever is lower. Okay. So the cost at which I have produced the goods, that will be obviously lower than the market price. So I will value my inventories at the cost of manufacturing it. Fixed assets such as buildings, plant and machinery, which are shown in a balance sheet, are valued at their original cost. And this original cost will be gradually eroded with use. That is, most of the fixed assets will depreciate or decrease in value with use. Okay, that is normal. With wear and tear, a machinery will obviously lose its value. It will lose its efficiency. Okay, so the allowance which is made towards this decrease in the value of the asset is called depreciation. And it is accounted as a non-cash expense in arriving at the profit for the period. Now, what do I mean by a non-cash expense? Depreciation is only a notional allowance for the wear and tear of the machinery and a consequent reduction in value. There is no cash flowing out of your pocket or no cash coming into you. It is only a notional value of reduction in the value of the asset because of wear and tear. So I hope that is clear. So it is a non-cash expense. There is no cash flowing out because of my providing for depreciation. Okay, we can go to the next slide. Okay. Now, just like we have talked about current assets and fixed assets, we have intangible assets. Okay. Intangible assets are those assets which provide long-term benefits to a company, but they do not have any physical form. Okay, I'll repeat it here. Intangible assets are assets which provide long-term benefits to a company, but which do not have any physical form. These are expenses incurred by a company, say in a particular year, but not accounted as such. Now, normally, if I have expenses in a particular year, I will treat it as an expense in that year. But in the case of intangible assets, I may not show it as an expense in that year, but I will collect all these expenses for that year, next year, and the year thereafter, and accumulate all these expenses over a period of time and treat it as capital expenditure. Okay. Now, expenses which are written off or which are treated as an expense in a particular year are called revenue expenses. And expenses which give you a benefit over a long period of time, they are called as capital expenditure. So, if there are certain expenses which I do not treat it as revenue expenditure, if I collect all those expenses, first year, second year, third year, and fourth year onwards, and group them together under one head, and I say, let me treat this as a capital expenditure because I will get the benefits from this expenditure over a period of time. The benefit is not going to come to me in any particular year. It will come to me over a period of time. So, to come back to my slide here, these expenses are treated as capital expenditure, like investment in a plant and machinery, whose benefits will accrue to the company over a period of time. Just as plant and machinery is depreciated, intangible assets are amortized. The effect is the same, but they are given different terms. Plant and machinery is depreciated, but intangible assets are amortized over a period, and the resultant amount for a year is shown as a non-cash expense. This also is a non-cash expense. This amortized amount for the year is also a non-cash expense, much like depreciation, which is allowed in the case of machinery. So to help you understand what are these intangible assets, let me give you some examples. For instance, there in the company, there may be an R&D department which is constantly working on the development of new products, which will be introduced in the market from time to time. Now, the expenses which are incurred in the research and development department, first year, second year, third year, and in the process, new products are coming out periodically. These expenses are added up together and are treated as added up as if it is a capital expenditure, and it is shown as intangible asset. Why it is shown as an intangible asset? Because the benefit of this research and development is going to be there over a period of time. As the new products are coming out, new products are getting sold, and you are making profit from the new products. So the benefit of the R&D expenditure is being felt over a period of time. Hence, it is treated as an intangible assets. Okay, and this intangible asset is gradually becoming less and less as the use of the asset is getting felt over a period of time. So it is getting amortized, just like depreciation in the case of plant and machinery. Similarly, you have things like patents. Now, if a company develops a patent, or it purchases a patent for a new product, okay, or for a new technology from an outside source, the benefit from that patent will be felt over a period of time. So what you purchase as a patent is shown as an intangible asset, which will give you a benefit over a period of time, year to year onwards, right? And likewise, you have another very good example of what is the intangible assets, and that is goodwill. Okay, a goodwill is something which differentiates one company from another company, a very superior company from another company. And this goodwill is often capitalized and treated as an asset. An instance of such a goodwill I can give you. So let us say you purchase a company, say company A purchases a company B, and in valuing company B, you come to a figure which is, let us say, 100. The value of a company B which you purchase is 100. But company A is willing to pay 120 for purchasing company B. In other words, it is willing to pay a premium of 20, which is over and above the 100, which is the value of the company when it is purchasing it. Now, this 20 additional amount which it is paying to acquire that company, it is because of certain things which are intangible, which are something which that company does, which is something which will give value to the purchaser in course of time. So we say that 20 is the goodwill which you have purchased. Goodwill 20 is a part of the total purchase price, but it is in the form of goodwill, which is over and above the valuation of the company. So that goodwill which you have paid for is also made a part as if it is a capital expenditure, and it is included in the assets of the company. Okay, so we can go to the next slide. So having looked at what are these various assets, we now look at the liabilities. Okay, what you owe, what the company owes. We have seen what the company owns. Now let us see what the company owes. There are three main groups of liabilities as shown on a balance sheet. Current liabilities, fixed liabilities, and shareholders' funds. Current liabilities represent a company's short-term finance, like credit given by the suppliers of raw materials. What does it mean? For example, a party supplies raw materials to you and it says that, okay, you don't have to pay me now, you pay me after 90 days. So I have the benefit of those raw materials with me for your 90 days without making a payment to the supplier. So it is a liability, it is a money which I owe to the supplier. So it is a part of current liabilities. Similarly, in the operations of the business on a day-to-day basis, I may need to borrow money from the banks for short-term use as an overdraft. Okay. So short-term borrowings from the bank, which are helping me in the running of the business, are also a part of current liabilities. Okay. Maybe I have similar, likewise, maybe there is some tax which is to be paid to the statutory authorities. Okay. And I have not yet paid that tax, but it is payable. So if it is payable to those tax authorities in due course of time, then it is becomes again a short-term liability. So we call it as a part of current liabilities. Okay. I hope this is clear. Now, besides the short current liabilities, we have what
Yes,
is
sir.
what is fixed liabilities. Fixed liabilities represent the long-term finance, like long-term loans from the banks, bonds and debentures which we raise from the public investors. That means we collect money from the public and we issue them a piece of paper saying that we'll return this money to you after so much time, and during that period when we have the money with us, we will pay you a certain interest. Now such kind of financial instruments are often known as bonds and or debentures, money borrowed from the public for long term use. And the bonds and debentures are usually for a period of not less than 3 years, mostly 5 to 7 years time, or maybe longer. Okay, so along with long-term loans taken from the banks, bonds and debentures are what is called the fixed liabilities of the company. And finally, we have shareholders' funds. Shareholders' funds represents the funds made available to enterprises by the people who have invested in the company on a long-term or permanent basis, and includes reserves and surplus. We'll talk about reserves and surplus shortly, but let us take it this way, that when investors have invested in the company, put their money into the company, that becomes as an equity of the company. Okay, as an equity of the company, and this equity is provided to the company on a long-term basis. Now, along with this equity, there will be what we'll show just now shortly. There will be retained earnings, which collectively, equity and retained earnings together constitute the shareholders' funds. Okay. Now, let us understand how the shareholder comes into the picture. To commence a business, an entrepreneur or a promoter forms a company. The company can be a partnership firm, the company can be a private limited company, the company can be a public limited company. So he forms a company to start a business. Now, can we go to the next slide, please? The funds which are needed to develop the business is invested in the company by the promoters and the investors who buy shares in the company. Okay, so what is a share? What is a share? A share is nothing but a document which says that such a particular person has put so much funds in the company, has invested so much funds in the company, and for that fund which has been invested in the company, that person who is the investor is provided with X number of shares. In other words, let us take an example. Suppose you have invested 1,000 rupees in a particular company, and the company says you have participated in the shares of the company. Each share is 10 rupees face value. So I will issue a piece of paper which says that the face value of the share is 10 rupees and you have invested in 100 shares of the company, which will mean 10 rupees into the 100 shares, the 1,000 rupees that you have brought into the company. So the company has received the 1,000 rupees as funds. And how these funds have come? Because you have invested in the shares. And what shares have you invested? You have invested in 100 shares, each with a face value of 10 rupees. Okay. Now, these shares which you invest in the company can be of two types. It can be an ordinary share or it can be a preference share. Okay, let us take the preference share. A preference share is a share which is expected to be either returned to the investor after a period of time, or which is frequently long, maybe 10 years or 15 years, or in some cases, it is not returned. If it is returned, it is called a redeemable preference share. If it is not returned, it is called an irredeemable preference share. Now, the preference share has the feature that there is a fixed amount, fixed return, which is paid by the company on your preference share. So if the preference share has got, it is a, suppose the preference share is a 8% preference share, it means, and the face value of the preference share is 10 rupees, that means 8%, 8% will be the return that it will fetch on a 10 rupee preference share. Right? So 8% will be the return on the face value of 10 rupees. And that is fixed. That is fixed for all time to come until that share is redeemed. The preference share is redeemed. Okay. And if it is not redeemed, then that 8% on the face value of the share will be paid to the investor for all time to come. Now, how does this situation differ from an ordinary share? In an ordinary share, the investor has invested that 100 shares at 10 rupees face value. But in this case, there is no assurance from the company that the share will be returned to you. So the share, the investment which has been provided will remain with the company for all time to come. Okay. Also, the company does not assure you that I will give you a fixed return like in the case of a preference share. You may get a return, you may not get a return. Okay. If the company makes a loss, you will not get a return. Even if the company makes a marginal profit or not such a good profit, you may not get a return. The company may not pay you anything. Okay. On the other hand, if the company makes a very good profit and continues to make very good profit, it can give you a return which keeps changing from year to year. That means in a year of good profit, it may give you a 10% return on your face value of 10 rupees. But if in subsequent years the profits have become even more and more, it may give you a 20% return, 25% return. And sometimes even it can give you a 100% return. So if you have invested 10 rupees, you will get 10 rupees as a return on that share in that particular year. Yeah. So in that sense, an ordinary share is open to risks much more than the preference share. That means you can get heavy returns, you may not get a return. If the company makes a loss, it's possible that the money you have invested in the company that may also get totally lost. So an ordinary share in a true sense is a risk capital which you have put into the company. Ordinary share is a risk capital. Okay. Now, this money which you have put into the company, these are described as capital which has been issued. This is the capital which has been issued by the company, and it forms a part of shareholders' funds. Shareholders' funds are also referred to as net worth, which includes earned surplus and capital surplus. Okay. And it's collectively referred to as reserves and surplus. So look at the variety of names. We have shareholders' funds, which is also referred to as net worth. Okay. And in the shareholders' funds, there is what is a bifurcation, what is called earned surplus and capital surplus. And this sum total of earned surplus and capital surplus is called reserves and surplus. Now, what are these surpluses? Earned surplus represents profits that have not been paid out to the shareholders by way of return on their investment. That means on that 10 rupees face value which I have invested, and for the 100 shares, okay, if the company has paid me some return, fine. But if I have, out of my profits, if I have not paid certain amount to that investor and I have held that profit back, it is earned surplus. So earned surplus represent profits that have not been paid out to the shareholders by way of return on the investment and has been retained in the company. It is also described as retained earnings. On the other hand, capital surplus is profit that is not made from the normal operations of the company, but for example, if I have sold some assets of the company, I have sold some plant and machinery in the company, which is no longer required, and I have made a profit on the sale of that plant and machinery, that goes towards the capital surplus. Likewise, there is another good example of our capital surplus, which is the premium on shares which are issued. For instance, a company may like to raise funds from the stock market by issuing new shares. Now, when it goes to issue the new shares, it says that while the face value of my share is 10 rupees, I am going to issue the shares at not 10 rupees, but at 25 rupees. In other words, 15 rupees more have to be paid by the investor in order to get one share of 10 rupees. So this additional 15 rupees, which is paid by the investor to get one share of 10 rupees, is called share premium. So all this money, extra money, which is collected, this 15 rupees per share, which is collected by the company as share premium, that also becomes a part of capital surplus. Are we okay? I hope
Yes,
we are
sir.
okay so far.
Yes, sir.
Okay.
Yes,
All
sir.
right. Definitely at the end of the session, we'll have questions and answers. So if there are any things which are not understood, okay, please put it in the chat box and I will try to answer those questions. Okay. So can we go to the next slide, please? Okay. When there are sufficient profits, the shareholders will expect a compensation or return for the money they have made available to the company, right? That is what they have invested by way of shares. Shareholders are compensated by payments, which is called payments, and these payments are known as dividends. So what is a dividend? A dividend is a payment which an investor in the shares of the company receives because of the funds he has made available to the company. So he receives dividends. Now, besides the dividends, shareholders also get compensated. And when I'm talking about shareholders here, I'm referring to the ordinary shareholders, the people who have invested in the ordinary equity of the company. The ordinary shareholders also get compensated by way of capital appreciation if there is an increase in the price at which the share is traded in the stock market. So if the prices of the shares are going up, we say that the share prices are appreciating. And the person who has bought those shares, he is at liberty to sell those shares at the higher price in the stock market. So the investor in the ordinary shares not only gets the dividend, but he also has the prospect of getting an additional amount by selling the shares at a price which is now ruling at a higher level than at the price at which he has bought the share. So that becomes an additional profit to him. So we say the profit is coming from capital appreciation. So the net return to the investor would then become not only by way of dividends, but also capital appreciation in case he chooses to sell the share. Okay. So that becomes the return to the shareholder if he chooses to sell the share. Now, so we have understood what is shareholders' funds. Now, there is another very important element in liabilities which is not reflected in the balance sheet, in the assets and liability side, and the liability side of the balance sheet. There can be instances where the liability of the company is yet to be concretized because of a dispute. For example, there's a demand for additional tax, maybe made by the taxation authorities or made by the GST authorities. They have demanded additional payment from the company by way of either income tax, corporate income tax, or by way of additional GST to be paid by the company. Okay. Now, the company has disputed these demands of the tax authorities. Okay. So the matter might have gone to adjudication. It may be before an appropriate tribunal, which is yet to decide on the matter. So until such a decision is taken by the tribunal, this amount, there is an amount which is owed by the company to the statutory authorities, but that amount has not yet been concretized. Therefore, that is not provided as a liability in the balance sheet. However, there is a declaration by the company either in the notes to the accounts or in the auditor's report, the auditor who has audited the accounts, there is a reference to that this is the amount of claim which is pending before the tribunal. So the company has to make a has to keep this in mind, that such a liability could arise. Okay, could arise. So it is called a contingent liability. It is called a contingent liability. Why we are discussing contingent liabilities here is that when you read a balance sheet, when you read the annual reports, and you see, after having read all that, and you go to the notes to the accounts or go to the auditor's report, you should look for whether there are any references to contingent liabilities, because that could become a huge liability in due course of time. Huge liability in due course of time. I'll give you an example which happened many years back. Many years back, there was a claim made by the tax authorities, okay, indirect tax authorities, for excise duty from ITC. All of you know ITC is a well-known company in Kolkata. Okay, the tax authorities, the indirect tax authorities, made a claim on ITC for 3 crores of rupees for excise duty evasion. That means they said that you have evaded excise duty in production of cigarettes, and this evasion which you have, this thing is for 3 crores of rupees. And the company has now to pay the 3 crores. Now 3 crores is not a small amount. And that's, if the 3 crores goes away, then the profit of the company comes down significantly. Okay. So this kind of a dispute went on for many years. It went up, right, dispute before the tribunal, then before the high courts, and finally I think it was settled at the Supreme Court level, that whether that liability, evasion of excise duty of 3 crores was justified, what the claim was justified from the tax authorities or not, or the company was right in disputing the claim. Okay, so those kind of things are there, are the contingent liabilities, and we need to keep a watch for these contingent liabilities in the annual reports of a company. Okay, we can go to the next slide, please. So the balance sheet, along with the profit and loss statement, provides information which helps one to assess 3 main aspects of a company's position. Now, the balance sheet taken together with the profit and loss statement. Okay, the two are 2 sides of a coin. Okay, if you have a balance sheet, you must also have the profit and loss statement going along with it. So taken together, it helps us to assess 3 aspects of a company's position: the solvency, liquidity, and profitability. You must be very, very comfortable and conversant with these terms, that what is the solvency of a company, what is the liquidity of a company, and what is the profitability of the company. If you are to look at the financial health of a company, you have to look at all the 3 dimensions: solvency, liquidity, and profitability. Liquidity and solvency are concerned with the company's ability to meet its liability. Okay, liquidity and solvency are concerned with the company's ability to meet its liabilities. A company is said to be solvent. Let us look at solvency first. Company is said to be solvent if its total assets are greater than its fixed liabilities. What were the fixed liabilities? Long-term loans from banks, debentures, bonds, and such things. Okay. So if the total assets are greater than its fixed liabilities, a company is said to be solvent. Okay. But we have to look at the degree of solvency. The ratio of difference between total assets and the fixed liabilities to total assets. So you are taking a ratio of the difference between total assets and the fixed liabilities divided by the total assets is called the solvency ratio. Again, I'll repeat it. total assets minus fixed liabilities in the numerator divided by the total assets is called the solvency ratio. Okay. Indirectly, this also indicates the proportion of shareholders' funds to total assets. A popular way of indicating the solvency of a company is to look at the debt equity ratio, which is nothing but the solvency ratio recast in a different form. We call it the debt equity ratio, which is the ratio of the fixed liabilities divided by the shareholders' funds. Fixed liabilities divided by the shareholders' funds, we call it the debt equity ratio. Very, very important parameter which we have to look at when we are doing a fundamental analysis for a company and we are looking at its financial statements. Okay. How much is that? We will discuss in more detail. For the time being, I'm just pointing it out. A debt equity ratio is a very, very important parameter to be looked at. Can we go to the next slide, please? Okay. A company is said to be liquid if it can. Now we have talked about solvency, liquidity. Okay. A company is said to be liquid if it can meet its current liabilities out of its current assets. Okay. So a company is liquid if it can meet its current liabilities out of its current assets. There are two ratios which are used to assess liquidity: the current ratio and the quick ratio. The current ratio is given by current assets divided by the current liabilities, and preferably this should be more than 1. Okay. Quick ratio, we have talked about quick assets earlier. Quick ratio is the current assets minus the inventories divided by current liabilities gives the quick ratio. Right? So these two ratios are an indication of the liquidity of the company. Debt equity ratio is an indicator of the solvency of a company. Now we go to profitability. A balance sheet shows what are the resources used and the use of those resources as on a particular date. It is not a statement of the results of the company's operations in a particular year. Mind you, it is not a statement of the results of the company's operations in a particular year. That is provided by the profit and loss statement. Okay, so the results of the operations of a company during a particular year is given by the profit and loss statement. The position of the assets and liabilities as on a particular date is given by the balance sheet. Okay, can we go to the next slide? So profitability is the relationship between profit made and the financial resources employed to make that profit. I'll repeat here. Profitability is the relationship between the profit made and the financial resources employed to make that profit. Okay. The profit reckoned is the net profit or the profit after tax for the year after deducting all expenses, including non-cash expenses. That means non-cash expenses are, if you recall, depreciation and if there is amortization. So after deducting all expenses from your sales, you come to a profit, and on that profit you pay the tax, and that becomes your profit after tax, after deducting all expenses, including non-cash expenses. Since tax is levied by the statutory authorities and outside the control of the management, it is more appropriate to adopt profit before tax to judge the management's overall ability to yield profits. Yeah? See, tax is something which I have to pay. The rates of taxation are fixed. It is nothing I can do about it. If I make profit, I have to pay tax as per statutory norms. So it is usual that in evaluating the ability of the management to yield a profit, I look at the PBT figure, the profit before tax figure. Now, besides the profit before tax figure, I may also try to look at how efficiently or effectively the management has conducted the operations of the company. Okay, how efficiently it has conducted the operations of the company. So if to have a look at the operational management performance, I will look at a figure which is called profit before interest, tax, depreciation, and amortization. Profit before interest, tax, depreciation, and amortization, PBITDA. Often this is also referred to as EBITDA, earnings before interest, tax, depreciation, and amortization. It is also the same thing. So EBITDA. You often you'll hear some of these people who are using financial terms talking about the EBITDA of a company. The EBITDA is nothing but the same thing: earnings before interest, tax, depreciation, and amortization, or profit before interest, tax, depreciation, and amortization. Okay. Why this is used to judge the operations? Because tax, we have already seen, tax is something which is statutory, which you cannot help. Okay. Interest, before interest expense is not deducted. So before interest, why? Because interest is a part of your the sources of funds. Depending upon what is the mix of funds which you are using, how much of debt you are using, how much of the equity you are using, the interest amount will arise. And the interest amount is something which is a part of the financial management area. Okay, therefore, to just judge operations without bringing the financing into account, if I wanted to see, then I will keep the interest out. So I will not deduct interest. Okay. And also depreciation and amortization, those two are non-cash expenses. There is no impact on cash flowing out of the company because they are non-expenses. Therefore, I do not deduct this in arriving at the PBITDA. So operations have to be seen from that point of view. Now, the other part why EBITDA or PBITDA is relevant, I will explain in the next paragraph. Profitability is given by return on investment. So the profitability of a company and overall a total profitability of a company is given by the return on investment, which is defined by profit after tax divided by net assets. And what is net assets? Net assets comprises of net fixed assets, net of depreciation, plus net current assets, which is net of current liabilities. So current assets minus current liabilities becomes net current assets. Gross fixed asset minus depreciation becomes net fixed assets. So net fixed assets plus net current assets becomes net assets. So I divide the profit after tax by the net assets. That gives me the return on investment, or ROI. There is another very important profitability indicator which is called return on capital employed, and that is where PBITDA comes into the picture also. Return on capital employed is given by PBIT divided by net assets. Okay, divided by net assets. Now here you will see that the interest, it is before interest and divided by the total assets. In other words, the assets have been funded by both borrowings, long-term borrowings, and as well as shareholders' funds. The assets have been funded by both borrowings and by debt, by long-term funds, long-term debt. Okay. Therefore, if I am to judge what is the return I'm getting on the total net assets, I should not deduct the interest which is there on the borrowing part. Therefore, in the numerator, I take profit before interest and tax to judge return on capital employed. So the total capital I have employed on the total capital, what is my return? That is given by PBIT. So you have ROI, PAT divided by net assets. You have return on capital employed, which is PBIT divided by net assets. Okay, we can go to the next slide. Okay. Shareholders are more interested in the return on their investments in the company. That is the return on net worth. This is given by PAT divided by shareholders' funds. Obviously, you'll see that to judge a management capability, judge how the management has performed, I'm looking at return on investment, return on capital employed, and what is the current ratio, what is the debt equity ratio, all those which parameters I'm looking at to judge how the management has managed the company. But so far as the shareholder is concerned, he is concerned with the return that he will get on his investment. And what is the return that he will get on his investment is given by return on net worth, which is PAT divided by the shareholders' funds. Okay. Now, besides these ratios which we have just now discussed at length, there are some other relevant ratios which are important for consideration when we go into the basics of fundamental analysis. There is operating margin, which is PBITDA divided by sales. What is the margin profit margin I'm getting on my sales? So profit before interest, tax, depreciation, and amortization divided by sales. Okay. Interest coverage ratio. Profit before interest and tax divided by interest. How many times I'm able to cover the interest which I have to pay in a particular year? Debt coverage ratio. That means debt coverage ratio here is cash flow divided by fixed liabilities. Now, let me take the opportunity to just explain cash flow. How cash flow is different from net profit. Now, in arriving at net profit, you deduct depreciation and amortization, which are non-cash expense. Okay, right? There is no outflow of any cash on that account. So if I have to work out what is cash flow, not simply profit after tax, then I have to add back these non-cash expenses, depreciation and amortization. So cash flow is net profit, PAT, plus depreciation plus amortization. So what is the debt coverage ratio? Therefore, how much is the cash flow and how many times that cash flow is covering my fixed liabilities, which are my long-term borrowings, bonds, debentures, whatever. So how many times the cash flow is covering my fixed liabilities becomes the debt coverage ratio. Dividend payout ratio. The total dividend paid divided by the net profit. What I'm paying out as by way of dividends, total amount divided by the net profit. Dividend payout ratio. Earnings per share. Earnings per share. When we are talking about earnings per share, we are talking about earnings for the ordinary shareholder, not the preference shareholder, because we are looking at the how the shareholder who has put risk capital into the company, what type of earnings are coming to him. Because preference shareholders will get their preference dividend, which is a fixed amount. But the ordinary investor, ordinary shareholder will get a return or an earning which is fluctuating. Okay. So the earnings per share, if I have to find, will be the profit after tax, from which I might deduct the preference dividend, which is going out to the preference shareholders, and the resultant earnings for the ordinary shareholders, which is given by PAT minus preference dividend, earnings for the ordinary shareholders divided by the number of ordinary equity shares which have been issued will give me the earnings per share. Very, very important metric. We will use it again and again in fundamental analysis. So I think we should all be very clear what is earnings per share. Earnings per share is nothing but the net profit from which I have deducted, if there is any preference dividend. So the profit which is which is earmarked for the ordinary shareholder, okay, divided by the number of ordinary shares issued. EPS. Another next very, very important ratio, price earnings ratio. Market price per share, what is the price at which the share is trading in the market, divided by the earnings per share. Earnings per share, as we have just calculated in the preceding metric, earnings per share. So market price per share divided by the earnings per share. Price to book value per share. So market price of the share divided by the book value. Now, what is the book value of the share? Okay. What is the book value of the share? The book value of the share is nothing but the total liability side minus the long-term liabilities, and you are left with basically the shareholders' fund net worth divided by the divided by minus the capital divided by minus the preference capital divided by the number of shares. Okay, so what you have here, in other words, will be the ordinary equity capital plus the reserves and surplus. Don't take the preference equity amount into account, and divide that amount of ordinary equity capital plus the reserves and surplus by the total number of ordinary shares. You get what is called the book value per share. Right? Dividend yield. Dividend yield is nothing but the dividend which you are actually paying on each share to the ordinary shareholder divided by the market price of the share. Okay, the dividend which you are actually paying to the ordinary shareholder divided by the market price of the share. Dividend yield. Is there any other metric? It is getting cut in my slide. Is there any other metric below this?
No, sir.
Okay. So we have therefore looked at how to now connect the balance sheet and the profit and loss statement, and we have looked at what is therefore the various ratios which are important by connecting the balance sheet and the profit and loss statement. Okay. Question is, what are the limitations of the balance sheet? Okay. These are all the financials, and as we have said earlier, that anything which can be expressed in monetary terms is reflected in the balance sheet and the profit and loss statement. But what about those items which cannot be reflected in monetary terms? So one of the major limitation of a balance sheet is it takes into account only those items which can be expressed in monetary terms. Those which cannot be expressed in monetary terms, there's a problem. Now, in certain innovations which have been brought into the balance sheet, certain items which are non-financial in nature, they have also been now converted into a monetary figure and put into the balance sheet. But those are what I would say certain innovative treatments of the balance sheet. So those innovative treatments of the balance sheet will not get into. We will talk about those things which are important. Surely we'll talk about them because they are a part of fundamental analysis. But in our understanding of the financial statements, which is balance sheet and profit and loss statement, such innovations are not to be taken into account. So the balance sheet reflects only those items which can be expressed in monetary terms. Other limitation: the value shown for some of the assets may not be realistic or accurate. For example, we may be showing the inventories in the balance sheet. Okay. Now, when we show the inventories in the balance sheet, there are different ways of valuing inventories, like just in, first out, on basis of average and all that. So it is possible that when we value inventories by some of these techniques, the precise or the most realistic figure may not be reflected. But such methods of valuing inventories will be disclosed as in the notes to the account as to what is the method of valuing the inventories. But that does not take away the fact that whether the inventories are correctly valued, most accurately valued or not, there is always a question. Third thing is, it assumes that the real value of money remains constant. The real value of money remains constant. Now, you look at a balance sheet from year to year. You compare the balance sheet from year to year. You look at the assets and liabilities year to year over a period of 3 years, 5 years, 10 years, whatever it is. Okay. Now, during the period, there has been inflation, right? So if there has been inflation, surely many of the things which are reflected on that balance sheet in your asset side, for example, the value of those may or may not be right. May or may not, because due to inflation, the prices or the costs at which the items are still getting reflected in the balance sheet, they may not be holding, they may not be true. Now, there are there are provisions where you can revalue your assets. We'll not get into that here, because let us keep the matter simple so that everybody can understand. Okay, and those intricacies we can see at a later date. But the fact remains that from year to year, year to year, the prices at which the figures are reflected in the balance sheet, there is no adjustment for inflation in those figures. Okay. And finally, the balance sheet is based on historical data. So it is not possible to judge from the balance sheet how successful the company will be in future. Okay. After all, it is historical information. Based on that historical information, we will not be able to understand what are the prospects of the company going forward. And that is a very big question, very big question. Okay, it is one of the uncertainties with which fundamental analysis has to cope with. Okay. But at the same time, we cannot forget that historically, how the company has performed is reflected in the balance sheet of previous years. How the company has performed, possibly it is an indicator of how it will do in future as well. Okay. Therefore, the inputs which we take away from the balance sheet are very important in going forward into fundamental analysis. So I think this set of slide is over. Now, could you please go to a slide in Word, which is illustration, how to read a balance sheet illustration. If you could go to that set of slides, please.
Okay, sir.
How to read a balance sheet illustration.
Yes, sir. Yes, sir. Just
It is a Word document.
yes, yes, sir. Just a minute, sir. I just open it. Yes, sir. It is visual, sir.
Yeah, absolutely, absolutely. Yeah, you'll have to scroll this down slowly. Okay. Yeah. So having talked about the balance sheet and the profit and loss statement, I wanted to share with you an illustrative balance sheet and an illustrative profit and loss statement. So if you slowly scroll this down, Professor Sogoto, slowly scroll this down. As you'll notice here, that on the asset sides, we have got the fixed assets, land, buildings, plant and machinery, manufacturing tools, vehicles, furniture, and we have goodwill at cost. And then we have less depreciation or amortization, and we have total net fixed assets. Now, a balance sheet invariably shows not only the position as on a particular date of that year, but it shows the comparative figures for the previous year as well. Okay, that is the feature of the balance sheet. It shows the assets and liabilities as on a particular date for that year, and also the comparative figures for the previous year on the same date. So here you have, in this example, you have got December 31, 2018, and you have got December 31, 2017. Okay. So the comparative figures. Yeah, we can scroll down. Yeah. What is this? What is yeah, slowly. What is this investments? Marketable securities. The company may have invested in the stock market. The company may have put certain money in certain mutual funds. Okay. So the investments of the company from the surplus cash which it has made, those are investments which the company has made to park their surplus funds and earn a return on that. So those are called marketable securities. That means those which can be sold in the market. So in the year 2018, there are no marketable securities, but in the year 2017, as on 31st December, it had 2,000 rupees of marketable securities, which possibly it has sold, and that is why it is not appearing in the December 31, 2018 balance sheet. Yeah, we can scroll down. Yeah, scroll down. Yeah. 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 One. Yeah. Slightly go up. Slightly go up, please. Yeah. So current assets. Yeah. So current assets, as you see here, we have cash in hand, cash in bank. Then we have sundry debtors. That means money which you have to collect from your customers. Similarly, other receivables, deposits, things which you have put your money somewhere, and that money is actually owed to you. So deposits, advances given to employees, that money you have given, so that is owed to you. Inventories at cost or market value, whichever is lower. Finished goods, work in progress, raw materials, other supplies. Okay, then you have given advance income tax. Okay, you have paid your income tax in advance. That is money which you have given to the other party, but in advance. So strictly speaking, that is still not their money. You have paid that in advance, so it is money owed to you. Prepaid expenses, expenses which have not been incurred but you have paid in advance, that again becomes a part of your current assets. Okay, we can come down. Yeah, less provision for doubtful debts. What is this provision for doubtful debts? It is possible that the company has examined the sundry debtors, and it has found that there are certain debtors, that means money which is to be collected for the sales it has made to some customers which are beyond 3 years. That means it has not been able to collect money for the sales it has made to some customers for more than 3 years. It has not been able to collect the money. So therefore there is a doubt. Will I be able to collect that money or not? So if I don't collect the money, just in the event of my not collecting the money, which has been pending to be collected for almost 3 years now, I make a provision for what is called doubtful debts. So those current assets, those sundry debtors, I write off. I strike them off from my sundry debtors. Okay. So if I strike them off from my sundry debtors, I say I have made a provision for doubtful debts. Okay. So this is 3,200, which is appearing here, is the provisional for doubtful debts. And what will happen? What will happen is, just because I have struck it off from my balance sheet, I have to show this as an expense in my profit and loss statement, because these debts have been written off. If I have to write it off and not show it anymore as collectible, I have to show it as an expense. Provision for doubtful debt, I have to show it as an expense in my profit and loss account as an expense, revenue expense. Okay. Now, in a parallel analogy, let me give you the example of non-performing assets of banks. Now, the banks, this term may or may not be familiar to many of you. Non-performing assets. Non-performing assets of a bank are nothing but the loans the banks have given to the customers, and the customers are not able to return those loans, so they have defaulted on those loans, and those loans are no longer going to fetch interest and the return of the principal to the bank, so they have become non-performing. Now, those non-performing loans, they are referred to as non-performing assets. So the bank may decide to write off those assets. So if they write off those assets, where the customer is no longer paying back the interest, the customer is no longer returning the installment, then when they write off those loans, they have to make a provision in the profit and loss statement of the bank, writing off the non-performing assets. So the profit of the bank will sharply come down if you write off a lot of non-performing assets. So you can see where the correlation comes. So if I write off doubtful debts, it is shown as an expense in the profit and loss statement, and it reduces my net profit or the profit before tax. Okay, so we can scroll down. Now, having seen the asset side, let us look at the liability side. Okay, yeah. So on the liability side, we have shareholders' funds, issued capital, which is appearing. That means so many shares have been issued at a face value of 10 rupees. That is your issued capital. Capital reserve. Capital, in case the shares have been issued at a premium more than the face value, then the additional amount which has been collected will come in as a part of your capital reserve. As an example, I'm giving you. Then you have got revenue reserve. Revenue reserve is nothing but that earned reserve, which we have referred to earlier. That means revenue reserve is nothing but retained earnings. Money which you have not paid out to your investors, to your shareholders, but you have held back in the company, that goes towards your retained earnings. That is revenue reserve. So the sum total of the issued capital, the capital reserve, and the revenue reserve or the earned surplus total ups to total shareholders' funds. Right? Okay. Next, we have got the fixed or long-term liabilities. Okay. Loans from financial institutions, if there are debentures which you have collected from the investing public. Okay. So sum total of that makes the total fixed liabilities. Okay. So in a way, you can say the shareholders' funds and the total fixed liabilities are, sometimes it is referred to as outside liabilities, not necessarily that which should be shown as such, but shareholders' funds and fixed liabilities definitely are shown in a balance sheet. Yeah, can we come below this? Scroll down. Now, yeah, now we have, yeah, can we go up a little bit, please? Can we go? Yeah, current liabilities. So current liabilities, this is also on the liability side. We have bank overdraft, short-term borrowing from the banks, sundry creditors, that means money which I have to pay to my suppliers and I have not paid for the raw materials they have supplied to me. Other accounts payables which may happen. Provision for taxation, that means it is tax is to be paid, not yet paid. So I have to make a provision for the liability. Provision for accrued expenses, certain expenses I have incurred but not yet paid. So it is owed to somebody. Interest due on fixed liabilities, if it is payable during the year. If it is payable during the year, so the interest which I have to pay on my long-term loans and it is payable during the year, so that interest which I have to pay, that goes towards, that means on fixed liabilities, the interest to be which is to be paid becomes part of my current liabilities. Interest to be paid on the fixed, on those long-term loans, which is payable during the year. So it is to be paid to somebody. So it's a liability which I owe to somebody. So interest due on fixed liabilities. That becomes my total current liabilities. Now, in many balance sheets, there is a way of presentation in which these current liabilities are not shown as a part of total liabilities. These current liabilities are deducted from the current assets, and current assets minus current liabilities are shown as net current assets. That is also a form of presentation which is adopted by many companies. Just to repeat myself, the current liabilities are deducted from the current assets, and current assets minus current liabilities are shown as net current assets on the asset side of the balance sheet. I hope this is clear. So if I deduct the liabilities from the current assets, current liabilities from current assets, it becomes net current assets, and net current assets is shown in the asset part of the balance sheet. Yeah, we can scroll down. Yeah, this is the profit and loss statement. So profit and loss statement, we can scroll down. Sales minus cost of goods sold, minus cost of goods sold, okay, gives you the gross profit. Okay, now from the gross profit, I deduct various selling, administration, and general expenses. Okay, of nature. And I come to operating profit. Now, from the operating profit, I deduct the interest expenses and I come to profit before tax. From the profit before tax, I deduct the tax and come to profit after tax. Okay. Now, one thing which you will notice here in this form of presentation is that depreciation is not being shown in the profit and loss statement. Now, that depreciation has been accounted for in the cost of goods sold. Okay, because when I price my goods, when I cost my goods before fixing my selling price, I cost my goods including the depreciation, which is to allow for the wear and tear of the machinery. So my cost of goods takes into account the depreciation allowance also. So the depreciation has been provided for in the cost of goods sold. In certain presentations of the profit and loss statement, the depreciation figure is shown separately. But in this what I'm showing you, the depreciation has gone into the cost of goods sold. Okay, can we scroll down? Yeah. Yes. Can you scroll down? Yeah. Statement of revenue reserve or retained earnings for the year ended 31st 2018 and 2017. Now we start with the opening figure here is balance brought forward. That means whatever is the revenue reserve of 2000 or 2017, that has been taken as the opening figure. So you will see here that the revenue reserve of 31st December 2017 is 11300 on the right hand side, 11300. That 11300 is appearing as balance brought forward as 11300 in the 2018 column, right? Now to that figure, I add the net profit for the year. Net profit for the year 2018 is 11266. Therefore, what is the balance I have? 22566. Now out of this, I paid the dividend. I pay the dividend. And the dividend for the year 2018 is 5,000. So what is my revenue reserve or retained earnings at the end of December 2018? It is 17566. I hope this is clear.
Yes, sir.
Yeah. Now
Yes,
can we
sir,
scroll
yes.
down? Can we scroll down? Yeah. Yeah. Can we a little more? A little more, please. A little more. Yeah. Now we have a statement which is again a very important statement, and this is what is called a sources and uses of funds statement. Similarly, you can have what is called a this is called a fund flow statement, what you see. Similarly, you could have a cash flow statement. I will explain the cash flow statement and the difference with the funds flow statement shortly. But first, let us understand what is the funds flow statement. That means what are the sources of funds to me? Net profit for the period is a source of funds. Depreciation is a non-cash expense. There is no cash outflow involved. So I have to add back the depreciation. Yeah. Because no expense has been incurred on depreciation. It is only a provision. It is a non-cash expense. So I have added back the depreciation. Okay. And during the year, I find that new share capital has been issued and subscribed. So if I go back to the balance sheet and go to the shareholders fund statement, I will find that new shares were issued. So if new shares were issued, the money collected from the new shares, that is appearing as that 20,000. So these are my sources of funds for the year. Uses of the funds, I have paid dividends. So dividends paid. If I have purchased fixed assets, that is appearing here. Now you can say that from where is this purchase of fixed assets appearing? It can be calculated from the balance for the year 2017, 31st December 2017, and you look at the fixed assets December 2018, and if the fixed assets on 2018 is more than the December 2017, it means assets have been added. Okay, just to give you an example, just to give it. And so assets have been added. So those assets which have been added are worth 1400. Similarly, you'll find increase in working capital. Okay, increase in working capital. Working capital is often defined as increase in net current assets. What is working capital? Working capital is often defined as net current assets. So if I go to the balance sheet and I look at, let us say, let us go to the balance sheet. I think Professor Sogoto, will you scroll upwards again and go to the current assets side? First go to the current assets side, and then I'll come to current liability side. Current asset side. Sorry, current assets. Total current assets. Let us see total current assets. Yeah, scroll down a little bit. Yeah, little bit. Yeah, little bit more. Scroll down. Yeah. Total current assets. 1 minute. So 1 minute. So you'll see here, total current assets in the year 31st December 2018, 267,000. Total current assets in the year 31st December, ending 31st December 2017 is total current assets 333,400. Okay. So what do you notice? Current assets has declined. So 2018 current assets minus 2017 current assets, you are coming with a minus figure. So current assets decline, minus. Okay, fine. It has reduced. 333,400 has come to 267,000. So current assets has declined. So increase in current assets is not there. There is a decrease. So minus current assets is minus a particular figure, 333,400 minus 267,000. This is current assets. Now come to liability, current liabilities. Can you scroll down? Yeah, come to current liabilities. Yeah, total current liabilities. Total current liabilities, now you see, in the year, at the end, 31st December 2018, it is 82974. 82974. And what was it as on 31st December 2017? It was 178,860. So present liabilities has decreased compared to the previous year's liabilities. So if I take 82974 minus 178,860, I again come with a minus figure. Okay, I again come with a minus figure. Now working capital is increase in current assets minus increase in current liabilities. Now in this case, there is not an increase, so there is a decrease in current assets, which is a minus figure, minus current liabilities is also decreased. So minus. So minus becomes plus. So minus current assets minus current liabilities. Current liabilities is also minus. So minus plus. So you will have current assets minus current liabilities becomes a plus figure, and that figure will be, if you now scroll down, please come to the funds flow statement. That figure, no, please go up, scroll up. Yeah, that figure will be, that figure will be 29486. That figure will be 29486. Increase in working capital, it will become a plus, because current assets minus, change in current assets minus change in current liabilities is plus, so it is becoming 29486. Net current assets is given by net current assets, or increase in current asset minus increase in liabilities becomes increase in working capital. It becomes this figure. So you have a statement which is the sources and uses of fund statement, which shows where the funds have come to the company and where the funds have gone from the company. Now, is something which I need to say at this juncture is, for you to understand what is the difference between fund and cash. So you may have a funds flow statement and you may have a cash flow statement. A fund flow statement is not the same as a cash flow statement. And just without going into too much of detail, I will just give you an example between what is a fund and what is a cash. Okay, so let us say, let us say you have sundry debtors. Okay, you have sundry debtors or money which is to be received and collected from a customer to whom you have sold your goods. Okay, so sundry debtors, the money you have to collect from a customer is something which is a fund which you will collect. It is a fund to be collected, right? It is a fund. I have sold something to a customer. The customer has not yet paid me. My money is locked up. I have not yet received my payment. So it becomes a fund. Okay. So the money locked up as money which is to be received from the customer is a sundry debtor, and the sundry debtor becomes a fund. Okay. But when I collect that money from the customer, that receivable, when I collect from the customer, it becomes a cash. So a fund flow statement may show that my current assets have increased because my debtors have increased. My fund flow statement, I may show my current assets have increased because my debtors have increased. That is fund. But when I collect the debtors, it becomes cash. So if I collect the debtors, it is an inflow of cash. So a cash flow statement will show me, so the collection of money from the debtors will come in as a part of my inflow, and it will be a cash. Right? So just a simple example so that you are aware that what is the difference between a fund and cash. Cash is actually the cash coming into you. A fund is something where you have invested the money, but it is yet to be collected. Okay. So you have used your money and it is locked up in funds, locked up in working capital, locked up in current assets. But when you collect that money, it flows into you, it becomes cash. So a cash flow statement will be different from a fund flow statement. Right? Okay. So, yes, Professor, can you scroll down? So finally, I have put on display here that what are the key metrics usually analyzed in a historical financial analysis. So by looking at the balance sheet, the profit and loss statement, interrelationships between the various parameters in the balance sheet and the profit and loss statement, we have a list of ratios which are quite relevant for fundamental analysis, which is very, very crucial. So now you will appreciate why an understanding of the balance sheet and P&L is so very vital. Because unless we understand how these things where these things are coming from, and what is the relevance of these various ratios, we will not be able to appreciate the use of them in the working out of the intrinsic value and working out of the analysis on fundamentals. Okay, so this is only a list. Some of them we have already discussed with, so I need not go over it again. Can you just scroll down, Professor? Just scroll down slowly. Yeah. Yeah. Okay. Right. So with that, this session on how to read a balance sheet uh, uh, is over, and I'm open to now any questions which you might have posted in the chat box. I'll take some questions. Professor Sogato, if you could help me with, if there are any questions in the chat box, and you can read out the questions to me.
So still we are not getting any question about the delete.
If there are any questions.
Yes, sir. If anyone post any question, then I will. I request to all students, please write down. Do you have any questions? Please write down in the chat box. Okay. The yes, sir. One question is coming, sir. How does the firm decide the face value of a share? The
Yes,
Shomik
that's
Chatterjee, the
yes,
Shomik
yes,
Chatterjee has
yes. I think that's a very, very interesting question. Uh, see, you see, face value of a share can be, say, let us say, hypothetically, it can be, say, rupees 10, it can be rupees 100. Okay. Now, the question which you have rightly asked is that should we have a face value of 10 rupees or should we have a face value of 100 rupees? Okay. Now, there are basically two questions, two issues involved here. One is, one is that if you want the investing public uh, to find your share affordable, and you want to attract a lot of people to invest in your company, and you want them to buy more shares, it is better to keep the face value 10 rupees. More people are able to buy the share. But especially when there is an initial public offer, that means the first time you are going to the share market and you are going to the market to invite investors to invest in your company. It is called the initial public offer. So when you are going for the initial public offer, at that time you would like to attract more people to come and invest in the company. You want to keep the face value lower. So you may like to opt for 10 rupees rather than 100 rupees. Number one. Number two is that this face value, whether it should be 10 rupees or 100 rupees, this has to be also proposed by the company and discussed and settled with the approving authorities. That means it has to be discussed with the controller of issues in the ministry, in the company law affairs, Ministry of Company Law Affairs. It has to be discussed with SEBI, and after discussion between the company and the statutory authorities, you may come to a final decision that should I keep the face value 10 rupees or should I make it 100 rupees. Now, there is no sanctity in 10 rupees. You can have the face value even 5 rupees. Okay, so this is a matter for discussion and strategization from the company and how they are able to then get the approval from the statutory authorities for that particular face value. In this context, I may make a mention that at a later stage, a company can also split its shares into several more shares. So a 10 rupee face value share may be split into 10 1 rupee shares. It can happen. Or it can split it into 5 2 rupee shares, but the face value of 10 equivalent 10 rupees can be made into 5 shares of 2 rupees each. It can be made into 10 shares of 1 rupee each. So that is what is called a shared split. And at a later date, a company can always split its shares. Okay, of course, again in consultation with SEBI, controller of capital issues, and all that discussion has to take place, and that approval is given. Okay, so it is a matter of discussion and discretion. I hope I have able to answer that question.
Yes, sir. The another question is Dr. Rahul Sharma, sir, is the management department of UM Jaipur. He says, Good afternoon, sir. It's a very nice session. Sir, can you please suggest some basic things
Can
which
a little louder, please? Can you say that a
yes,
little louder?
yes, sir. He said, the good afternoon, sir. It is very nice session. Can you please suggest some basic things which is a non-commerce person can do the understand the balance sheet and take the investment decision? I
Last,
repeat.
can you read the last part? Last part?
Yes, sir. Yes, sir. Can you please suggest some basic things which a non-commerce person can do the understand the balance sheet and take the investment decision?
Yes. You see, uh, there are, so far as sources of understanding balance sheet is concerned, there are plenty of books that are available of which are of a basic nature. Okay, you can go to those books which are how to understand a balance sheet, how to analyze financial statements. There are lots of books you'll find. If you go to the net and search, there'll be lots of books available. You can choose the one which suits you. You to what level you want to go, you can choose. You see, today I have confined myself to something very rudimentary, very rudimentary, because I wanted it such that even those people who are not having any background, they can slowly understand the fundamentals. So I have kept things very rudimentary. I hope that has been understood. But you want to go further and add some more value to this one, you can. There are plenty of books available on this. Plenty of books. Okay. And more advanced analysis of financial statements, and there are various other intricacies which are there according to which is as per the rules and regulations of of the statutory authorities. So those provisions are there in our annual report. So there are books which will take you slowly from a very rudimentary stage to more advanced levels of analyzing financial statements. Plenty of it is available. You can go to the net for that. Plenty of that. Yeah.
Yes, sir. Next question
And
is,
how it is to be used in fundamental analysis, that is what we'll see in the later sessions. How we will use these in the later sessions is what we'll look at. Yeah.
okay.
Next question.
Sir, yes, sir. Uh, Onimesh Chandra says, sir, what are the marketable securities? What are marketable securities?
What are marketable securities?
Yes, sir.
Yeah. See, as I was mentioning to you, a company may have surplus cash. Now, some of that surplus cash, it can keep in the bank. Okay, cash in bank. Okay. Alternatively, some of that cash it can invest. The company can invest again in shares of other companies. The company can invest in mutual funds. Okay. So what is invest in those mutual funds, what the company has invested in the stocks of other companies, those are financial instruments which will fetch a return to the company. That means if it is invested in mutual funds and the mutual fund declares a dividend on the units, that dividend will come to the company as other income, not from operations, but it will come as other income, right? Now that mutual fund unit can be sold anytime by the company, so it is marketable. So the mutual fund units are a marketable security. I can sell the units at any time. Okay. And whatever income I get from those securities, like the mutual fund, comes into my income statement as other income.
Got it, sir. Thank you, sir.
Sir, the next question, Abid said, what is transfer pricing? Can you please explain it, sir?
Again,
What
come with the
is
question.
what is transfer pricing? What is
Yes.
transfer pricing? Can
Yes.
you please explain it, sir?
Yeah, I can definitely explain this, but this is going beyond the scope of our discussion. But I will explain it all the same, since you have asked that question. You see, a transfer pricing invariably happens when within a particular industrial group, within a particular industrial group, there are subsidiary companies, or within a company, there are a set of different types of factories which are producing different types of components and finished goods. Okay. So if you are going to transfer a good produced by one subsidiary company to another subsidiary company, Suzuki Japan is transferring certain components to Maruti Udyog in India. Those components are being transferred at a transfer price. Now I'll come, this is basically the definition of transfer price. If there are three factories within a company, one of the factories is making a component which is used by another factory as a raw material, and the first factory is also selling that item to outside people separately. It can sell to outside people, and it can also sell that item to another sister factory within the company. The price at which factory A will sell that component to the sister factory will be at the transfer price. So first you need to understand what is transfer price. Transfer price is what I have just now explained to you. Is that clear first? If that is clear, then what is the way to calculate the transfer price? That requires a much more detailed discussion, which I'm unfortunately I cannot go into at this stage, because then I will not be doing what I should be doing as a part of this workshop. Okay, but I've explained to you what is transfer pricing.
The next question, actually, the Animesh Chandra says once again, the romancing the balance sheet by
Uh,
Anil Lamba is
one
a
minute,
good read.
I didn't get it. Can you come again?
The romancing the balance sheet, the name of the books. The romancing the
Romancing the balance sheet.
balance
Yes,
sheets by the Anil
yes.
Lamba is a good read. Is a good
Later part,
read.
is it?
Romancing the balance sheet by
Yes,
Anil Lamba
yes.
is a good read.
Can you do it?
Nah, is a good read. Read.
It's a good read. Yeah,
Yes, yes.
yes. It is certainly a good read, and especially if you have some fraudulent ideas in mind. Especially if you want to manipulate the balance sheet, you will understand how people do it. And when we discuss in fundamental analysis, one of the things we will always be looking for is what are the red flags, how certain companies may be romancing the balance sheet and fooling the investors. Okay, so it is a good read. Romancing the balance sheet is a good read. It will help you to become aware of what pitfalls you should look for. Yeah,
Yes,
can we have the next question from
yes, sir.
somebody else?
Yes, yes. Mr. Shomik Chatterjee says, asks the question, sir, if a firm's current asset is more than its current liabilities, but on the other hand, the firm has a long-term debt, will it be a good idea to invest in the firm for 1 year time period? I repeat one
See,
again, sir.
yeah.
I
Let me
got
answer that.
okay.
See, we talked about two concepts: liquidity and solvency. The two are different concepts. Liquidity is your ability to meet your current liabilities. That is given by your current ratio. Current assets should be more than current liabilities. Current assets should be able to cover your current liabilities, which is basically short term. Okay, you should. So that is the liquidity. The company is liquid. On the other hand, if it has got debts and the debt equity ratio is less than 1, suppose the debt equity ratio, sorry, debt equity ratio is suppose more than 1.5. Debt equity ratio is suppose coming closer to 2. That means there are huge debts which are way above the shareholders' funds. Okay. Now, what you are looking for is the long-term viability of the company. The long-term viability of the company is definitely poor going by the solvency ratio or going by the debt equity ratio. Okay. Just because you are liquid now does not mean that you are in a healthy financial condition. You may not be in a healthy financial condition. And I think so far as fundamental analysis is concerned, we give more importance to a debt equity ratio in that respect, that you have to be financially healthy in the long run. So the debt equity ratio should be lower, preferably close to 1 or lower than 1. But 1.8 to debt equity ratio is not a good thing at all.
Thank you, sir. I didn't have any question till now.
Okay. Okay, then may I suggest something? If with the concurrence of the participants and yourself, because you are the coordinator, so go to sir. So uh, would you like to close this session earlier to 1 o'clock, and we can meet again at 2 o'clock for the next session?
Okay, sir. Okay, sir. It's okay.
If it is all right with the participants, so the next session will be at 2 o'clock.
Okay. Okay, sir. Thank you, sir, for a nice presentation. Okay, now I just, as per the permission of our principal, sir, so we like to close the session now, and we will meet again on 2 p.m.
Yes, if there are no more questions right now, then we may adjourn the current session. And thank you again, Professor PKB, sir, for explaining it in such like ground level terms, very layman terms. I'm sure all the students who have attended now at least know the terminologies that come into these financial statements, balance sheet, and profit and loss statements. We will be learning how to use the different elements of these statements, balance sheet and profit and loss, to find out if a company is a good investment opportunity or not. Here, basically, the fundamental or the basic like qualities of that company is being taught about. Thanks, PKB sir, and thank you, Shogata sir, for all the coordination activities. We may adjourn now, and we'll be joining back again at 2 o'clock.
Thank you, sir.
Thank you. Thank you.